most larger investors don't invest in tenant-friendly states, or we try to skew towards landlord-friendly states. And one of the big reasons for that, anyone who's lived or had property in California or New York as two examples, if someone doesn't pay the rent, you can take a year, 2, 3 years to actually evict them and take ownership back of your property. And that whole time, you're still going to be paying the mortgage, you're still going to be paying expenses, and it can really cripple you.
G'day, ladies and gentlemen. Welcome to another cracking episode, jam-packed with some incredible investing advice here on investing in the US. And today's a little different. I've actually got an awesome guest, returning guest, but also returning as my business partner. And we're going to dive into some really awesome topics. But let's introduce my guest for today. He is another Australian, good bloke, all-round good bloke. You've heard him on the podcast probably many, many years ago. If you rewind the clock all the way back to when the podcast first started, Ben, I believe, was on it, talking about how to get set up here in the US. Today, he's coming back as a business partner at RSN Property Group. But enough out of me. Let's get him out of here. G'day, Ben. How you doing, mate?
G'day, mate. It's nice to chat to you on the podcast after chatting to you every day. So,
and that was correct, right? I did say the right thing, that back in the day, you did the episode on getting set up here in the US.
I did. That must have been like 8 years ago when I had a business.
It must have been like 2015 or something.
Something like that. I had a business similar to like Roofstock, but targeted specifically for Australian and international investors coming to invest in the US, and it was all about how to get LLCs, bank accounts, be compliant with US legal and tax matters. And and as you know, maybe the guests don't know, that business has since been wound down, and Reed and I are in business at RSN Property Group doing multifamily investments, which is what we're here to talk about today.
Yeah, no, and a quick reminder to everyone listening, if you do have questions about getting set up here in the US or anything like that, we still know how to do it all. The rules really haven't changed a lot. So Ben is the expert on that. We do help our international investors coming into the US who want to invest here in multifamily. It's a small portion of our investor database, let's be honest, but we do still know how to do it. We connect people with all the good CPAs and lawyers out there that can help them get set up here legally and then can invest in our deals and other people's deals. But that's not what we're talking about today on the show. We're actually going to dive into the multifamily benefits and why we like to invest in multifamily. And we're going to cover a couple of different things. We're going to talk about how it works from a macro point of view, about why we're investing in multifamily. We're going to then dive into what is a good investment and what we perceive to be a good investment, and talk to the audience about the different things that we like to look at when assessing a new deal. And then we're going to talk about why is it a great investment for passive investors. This is going to be a series of podcasts you're going to see come out here over the next probably 3 to 4 months. Ben and I doing a little bit more of a deep dive into our business, into what we do day in, day out, because sometimes our listeners on the podcast don't know that we have an active business. They don't know about RSN Property Group. They just know about the books and investing in the US. So this is an opportunity for us to really show you guys, pull back the curtain on what we do day in, day out, which is the bread and butter of our investment business, which is RSN Property Group. With that being said, Ben, anything before we're diving into the major topics today?
No, you said it well. So I'm excited to jump into it.
Cool. All right. So we're going to talk, as I said, about why multifamily housing, right? And Ben and I are going to go back and forth and have a more of a conversational tone about this, but it's all from education, right? We're coming from a point that we've been doing this for nearly a decade. We have purchased over $700 million, I believe, in multifamily assets here in the US. So
830.
Yeah, well, there we go. So we just closed on one last week. So we are very in touch with what multifamily is. That's what we do day in, day out. We've completed 24 transactions over the past 10 years. So we know a little bit about multifamily. We're not trying to blow smoke around, but we are good at what we do, and hopefully you guys can get some good education out of it. So let's talk about why we've chosen multifamily investing. And I'm going to take this one, Ben, if you don't mind. But high level, we invest in multifamily housing, and but let's understand what multifamily housing is. It's exactly what it sounds like. It's multiple units. And when I first got started, I was buying duplexes and triplexes. And that is technically multifamily housing, but it's called residential, right? 4 units and less are residential. 5 units and more is called commercial. And today, back when Ben and I first got started, we were doing the small stuff, but today we buy Like we just closed on a 100-unit property in Phoenix, Arizona. We've closed on 250 units or 350 units. And these are bigger, large-scale apartment buildings, right? And they look like what you would see here in the US. And if for those international investors who may not, and we're not talking just to international investors, but those people who are listening from abroad, think of a bunch of apartments in a building, right? We're buying the entire building and we're providing housing to working class folks around the US. We believe that multifamily is a need. Like shelter is one of the human needs. Food and shelter is one of those things. And as affordability continues to become a problem, renters are going to continue to need to rent places, and the ability to buy a new house or get it started in the housing market by buying your first property becomes a little bit more unobtainable as affordability continues to be a problem. And thus we believe fundamentally that providing good, clean, safe, affordable housing for working class Americans is really where we provide that niche, right? So
and I'll add one thing to that. Like I'm a renter. I own property. We own the large apartment buildings. But for me, living in New York City and Brooklyn, it's a fake background here. I wish I lived somewhere with a view like this. But I choose to rent. And I choose to rent because I want to live in a part of town that if I wanted to buy here, it would be prohibitively expensive. So I kind of get the best of both worlds by renting where I want to live and then investing where I can get the maximum return for my investment. So I think you're going to see a lot of people catching on to that. I know Grant Cardone speaks about that strategy a lot. And I think more and more people are going to do that too. So yeah, there's a lot of good reasons to rent.
Right. And just quickly touching on, we're sort of jumping around a little bit, but the areas we focus on. So I'm maybe going to throw you a little bit under the bus here, Ben, but you spoke about New York City. We're not buying in New York City, but you want to tell people where we are buying and why we're buying there.
Most larger investors don't invest in tenant-friendly states, or we try to skew towards landlord-friendly states. And one of the big reasons for that, anyone who's lived or had property in California or New York is two examples. If someone doesn't pay the rent, you can take a year, 2, 3 years to actually evict them and take ownership back of your property. And that whole time, you're still going to be paying the mortgage, you're still going to be paying expenses, and it can really cripple you. Whereas in a place like Arizona or Texas or many other states that we invest in, if someone doesn't pay the rent, you try to work it out with them. But if you can't work something out with them, you can have them evicted in 30 days, 45 days, and you're able to bring that unit back online, generating income for ourselves and our investors, a hell of a lot easier than investing in a place like New York. And there are obviously a lot of investors in New York, and they really specialize and get really good at understanding the system here and making the most of it. And they're usually much larger in scale to be successful in some of these more niche cities. But we're playing in the places where it's easiest to play, where we can make the safest and most consistent returns. And that happens to be, the red states, the landlord-friendly states, Arizona, Texas, Carolinas, and more.
Yep. And then we talk about the Sun Belt. We talk about where we also look where people are migrating to, where things are growing. And the affordability play is big, right? New York, San Francisco, LA, sometimes can be it's really expensive to live in these cities. I live in Los Angeles and Ben lives in New York. But the average American, is looking for more affordable places. And you've seen post-COVID, and this is true before COVID, but people flocking to where things can be a little bit more affordable. You don't have to spend $600,000, $700,000, $800,000 on getting your first home. Places in Texas where the average home might be around $250,000 to $300,000, a little bit more obtainable to get the American dream. And they're the areas we're looking at, right? But we're not also looking at areas that are stagnant in growth. We want population growth. We want good employers there. We want to see the cities expanding, and with expansion becomes opportunities for us to come in and buy assets undervalued. And then, this leads us into sort of what we like to do. And then we go and add that value. So with that being said, I'm going to quickly now pivot and talk a little bit about how it works, in terms of how we go about our process of looking for deals. So we obviously, from a macro point of view, we identify different areas across the United States. We just mentioned a couple areas: Phoenix, South Carolina, Texas is, right? These are all areas that are growing. These are all areas which are good landlord-friendly states, but they're also good areas where affordability is big, right? So where it's attracting people from across the US. We can then go in and we look for multifamily assets, and we will underwrite or we will evaluate many deals in a market before we start buying a deal. So take Phoenix, for example. We've been looking at Phoenix for probably 3 to 4 years, 5 years maybe. And, in the beginning, we're not just flying in there and buying the first thing we see. We are spending time getting to know the area. So we probably spent 18 months before we bought our first asset there underwriting deals. So and when I say underwriting, it's just a fancy word for analyzing deals. And what we like to do at RSN is as we enter any new market, we like to spend time, 6 to 12 months, underwriting, analyzing every single deal we can, so we can get a feel for what a tenant's paying for rent, what are operating expenses doing, how the valuation of a particular property is going or trending towards. We also like to talk to local property managers and local property brokers to get an understanding and a feel for that area. We obviously don't live in these areas, but we need to study the market. And we do that by doing a desktop study, by underwriting a lot of deals. And I'm talking not just one or two, I'm talking about 50, 60, 70 deals in a market, and keeping that data and getting comfortable with where things are trending towards to then be confident to go and put a good offer in, to know that we're not overpaying for a particular property when we enter that particular market. From there, once we identify an asset, we'll then go and raise capital, right? Ben and I aren't just sitting on $50 million worth of cash. We have to go and find partners. And the partnership we form with our investors is called a syndication. And a syndication works in two ways. It is us leveraging our investors' capital for the down payment, but it's also our investors leveraging us and our expertise to go out and study markets and take time to underwrite 100 deals to bring them that one deal. So it's the best of both worlds, and it's an ability for both of us as the operator and as the investors to come together and form that partnership. And that's what we do. So Ben, any comments on that before we continue moving on?
You said it well, and I'd expand on that a little bit and say the types of investors we work with. Number one, you have to be an accredited investor, and that means that you have to have income over the last 2 years of $200,000 in each of those last 2 tax years. Or if you have a spouse, you can earn $300,000 combined. And the other way that most commonly people get accredited is to have $1 million in assets, excluding their primary residence. And there's a few other ways to get accredited, but they're the main two. And they're the only investors that we are permitted to work with. And inevitably that ends up being, lawyers, doctors, people working in tech, white collar professionals. But we certainly get a lot of people, blue collar guys who are doing really, really well, guys or gals. And then a lot of business owners. And that kind of forms the bread and butter of the people who are really good investor profiles to invest with us. And the other big thing, and I know we're going to talk about this a little bit later, is that the investments are 100% passive. So, when you're a high-powered tech worker or a lawyer, you don't need to be getting calls about a leaky sink or a blocked toilet on a Sunday night. Even if you've got a property manager, like I own properties and I have property managers, and you still end up having to talk about, significant repairs. You still need to have to talk about insurance matters or tenant issues. There's always things that bubble up, and that can just drive you crazy when you've got a busy week and you're trying to deal with stuff. So, the benefit to multifamily investing and syndications like Reed and I do is that it's 100% passive, and that really appeals to the investors that we work with. And I will pause there because I could talk about that all day, and we're not here to talk about raising capital all day.
And I want to come back to that. So just from a high level again, we underwrite deals or analyze deals in a market, and I'm going to talk a little bit about that now. We find deals, we put them under contract, we then raise capital from our investors and form the partnership, which is a syndication, and then we close on those deals. So let's talk about what does a deal look like? Why isn't everyone doing this? Well, there are other people doing it, and there are other syndicators out there, and we're not the only ones. And I'll first and foremost say that we encourage people to invest with multiple syndicators because that's a great way for diversification. But here at RSN, we look at multifamily assets where we know by doing those desktop studies, we know what renters will pay for a studio, for a 1-bedroom, for a 2-bedroom in certain areas of a particular market, like Phoenix or Austin or San Antonio or Greenville, South Carolina. And we can understand that based on the vintage of the asset. So let's just talk about the types of assets we buy. We typically buy existing assets that are built between 1975 and 2000 and that need we need to go in there and they need to be a bit of a refresh. But the main thing we look at is the income of the property. So we look at the in-place rents, and we can find out that information pretty easy. You can Google, an apartment building, and you can see on apartments.com what a studio's been rented for, or what a one bedroom has been rented for, or what a two bedroom has been rented for. Plus, we're also speaking with the local brokers and the local property managers. And so we have a very good finger on the pulse about what these things can rent for. And as we look at multiple deals, we can come across certain information about a particular deal, like a rent roll, and we can see, well, hang on, these tenants are not paying as much as what they should be paying compared to other properties in their local area. And so that is the value that we then say, well, the light bulb goes off. And that's where we can say, well, maybe these studio apartments can be brought up to market value, meaning, so say a studio apartment might rent for $1,000 a month, which might sound really cheap where you live. Well, in some parts of the country, that's the norm, right? But maybe the apartments in the local area a studio could rent for $1,200 a month, right? Well, why isn't this current property not renting for $1,200 today? Well, there's a number of myriad of reasons why it goes into that, but that's what we look for as when we analyze deals. We look for that difference between the market rents on studios, 1s, 2s, and 3 bedrooms, depending on the property, and seeing where we can push that rent to. So that's in theory the business plan. So when we find the deal, we identify the deal, put under contract, partner with our investors, closing the deal, we then want to go in and start renovating the property. Our main focus is obviously renovating the units to increase the rent. And again, we're not trying to push the rent above market rent or what other people are paying for. We're just trying to bring it up to market. But that doesn't happen overnight. We can't just walk in there and turn on the light and all of a sudden all the units, particularly like a 100-unit property or 150-unit property, all these units are now paying what they should be paying, right? It takes time. So we, as the operators, and that's what we do with construction management and our backgrounds in this space, is we go in and methodically renovate the asset. So we'll start with things that don't affect the current tenants, right? i.e. redoing the leasing center. So we'll renovate the leasing center. Might update the gym. We might renovate around the pool, all the amenities where the tenants like to feel like they call these places home. They want to feel like there's been love poured into that. And we go and find assets where a little bit tired, a little bit run down, and we'll come and put that love in. So we'll update the landscaping, we'll update the renovating of the leasing center, the amenities, the barbecue areas, adding dog parks, maybe even repainting the property because it might need to be repainted, maybe doing new roofs, showing some love to the asset that is maybe 20 to 40 years old. And then we do that in the first sort of 6 months. And then after that, or as we're sort of getting our feet underneath us, tenants will naturally move in and out every single month, right? So if you're looking at a 100-unit property, on rule of thumb, at any given point, you'll probably have a 5% vacancy. Now, you may have a higher vacancy depending if the existing owner was running it poorly or not, and that's where we find value as well. But by and large, you have a natural vacancy depending on the market. Rule of thumb, somewhere between 5 and 10%. So at any given point in the year, you should have 5 to 10% of units available to renovate, right? And that's where we come in and we'll renovate those units. We'll put in granite countertops, we'll put in undermount sinks, put new flooring in, give it a lick of paint, freshen it up, because some of these assets are 30, 40 years old and they look like they're 30 or 40 years old. And so tenants will then say, well, hang on, I want the upgraded sink. I want the upgraded gooseneck faucet. Okay, well, we can do that for you, but we're going to have to charge you an extra $150 a month. And they're like, okay, well, but let's do it because I want a fresh unit. And we do that methodically every single month. So maybe 5 to 6 units a month. And it will take us probably 12 to 24 months to renovate the entire property. And that's in general how we increase the rents, beautify the asset and be able to increase the value. And so I'm just going to pause there, Ben. Do you want to add anything to that, to those descriptions that I've been saying?
No, again, you've said it really well. So I don't want to jump in on that, but I think now's a good time to step into talking about how these assets are priced.
Correct.
Because single family assets are priced based on comps. So whatever your neighbor's house sold for is, somewhat going to relate to the price of your property. But for these, commercial multifamily assets, it works differently. And Reed, jump in when as I need assistance. But obviously, the amount of rent that the property brings in increases the net operating income of these assets. And the higher the net operating income, fundamentally, the higher the value of the asset itself. So by us pushing up these rents and making the property so much nicer, the value of the property as it's priced like a business is greatly increased upon sale time. And that's fundamentally how, the assets are priced and how we make our profits on this. But Reid, you want to clarify further?
Yeah. So back to what I was saying before about the income. So, you were starting from point X and we're trying to push it to point Y. And on that 100 unit example I said before about the natural vacancy where, month one, we will renovate 5 units, right? Well, those 5 units will need to be renovated, then they'll be put back in the leasing pool, and then they'll need to be re-rented at the higher price. And that slowly inches the income towards where we want it to go over the next 24 months. And in doing that, we do 2 things. We increase the cash flow of the property, which is going back to investors, but then we go back to what Ben was talking about, the value of the property, the net operating income, the income of the property has increased. Thus, the value has increased of the asset because in general, going back to commercial, the difference between commercial and residential real estate is that commercial real estate, like the deals we buy, are valued like a business. So if you increase revenue, you increase the value of the asset, you increase the cash flow, and that's the purpose of why we go and renovate the individual units over a period of time. So with that being said, let's dive maybe back into, we talked about how we look at deals. We talk about the types of markets we look at. We talk about the underwriting process. And there's a lot of nuances to that. This is a quick 30, 40-minute podcast. We're not going to be able to, explain everything in detail, but we're trying to give you a high level overview education of what we do. So if you are ever interested in investing with RSN, you can come along and you're coming with a little bit of knowledge before we start having that conversation. But Ben, do you want to quickly pivot to talking about the passive aspect of it, why investors particularly like to invest in hard assets and the benefits that go along with that?
Yeah, sure. So I think we touched on this before, and one of the most important things to understand is that these investments are truly 100% passive, with the slight exception at the start, when you would potentially invest in one of these assets, there's 2 key things that you really want to do. The first thing is to do a lot of due diligence on the operator. You want to find out about their track record. You want to find out about their team. You want to find out about how they run their business. We actually just sent a newsletter about this. So anyone on our mailing list has already got a pretty detailed article about the things that we think are important on that front. But we can't emphasize the importance of this enough. The person who is in charge of these investments is often many times more important than the asset itself, which sounds counterintuitive to many people. But you've got to think about it. If you've got the captain of the ship is someone who is, cracks under pressure or maybe just isn't experienced enough, doesn't matter how good the ship is, you're still going to hit into, rocky waters. So operator due diligence is very crucial. And then, of course, you want to do due diligence on the property itself, the property, and that encompasses as well the area, everything else that goes into it. So where's it located, the vintage, the business plan behind the property, all that stuff. So we could talk about, the due diligence that needs to go in a little bit more detail, but that's an important step. But once you've decided to invest, it really is as simple as wiring your money. And then you sit back and you get those monthly reports, the quarterly financials. If you have questions about how things are performing, you can absolutely get on the phone with, if it happens to be me and Reid, it would be me and Reid. If it happens to be another operator, you sure as heck want to have their cell phone to be able to ask questions. And again, after that, it's truly completely passive. So it'll be a 3 to 5 year hold period. You'll get quarterly distributions from the cash flow that the property produces, and then you'll get a lump sum payment at the end when the asset has increased in price. And this wasn't what we were covering, but just if anyone's out there wondering how we as operators make money, it's at that sale time. 70% of the profits go to investors and 30% of the profits go to us as operators. And that's fundamentally how we make our money. If the investment's a big success, we share in that, profit with the investors. If the investment is not a big success, heaven forbid, we don't make any money on the deal or very little money. There's some nuances there, but, fundamentally, if the investment is a success, we all benefit in that. So our interests are heavily aligned. And that's kind of the passive nature of it in a nutshell. I already talked about, the challenges with owning property, even with a property manager, so I won't go over that again. Reid, any final thoughts on that?
The other thing about the passive investments and is investing. Why would you invest in physical assets versus paper assets, like the stock market, right? I think the big thing
great point.
is going to investors who want exposure to real estate, but they don't necessarily have the time or the energy to go find that. And the reason you want exposure to real estate is because it's a physical asset, right? So part of the investing your dollars is you have things called depreciation, right? And depreciation is really, really important in these investments. So they talk about 4 different things when you're looking at an investment. There's going to be the cash flow of the property itself. There's going to be the amortization. That means, how the rental payments or that the renters are paying pays down the mortgage and creates equity. There's going to be appreciation or forced appreciation of the long period, which is what we spoke about, coming in, renovating the units, increasing that value. And the last thing is going to be depreciation, right? Which is the physical nature of the asset in that over time, a physical building will depreciate in value. And so investors can offset certain income, and I'm not going to get too technical about this, but it's compared to, say, a stock investment, which is called a paper investment. You may get a dividend of, say, 6%, but you have to pay Uncle Sam a third of that because you don't get any depreciation. It's not a physical. You're just investing in stock, so you get taxed on that. Investing in hard assets, you get to offset that income. So you may create 6% from cash flow in a year, but you get to offset that income from cash flow by the fact that the asset has depreciated over that period of time as well. And our goal at RSN is always to try and offset your income or the cash flow from the property versus how much depreciation you get. So you get to keep 100% of that 6% in that particular example. Ben, do you want to add anything to that before we keep going?
One nuance, the depreciation is actually held within the fund itself, and losses flow down to investors. It's fundamentally the same thing, but an important nuance. Something you touched on that I thought was important to bring up again is the portfolios that people hold. And what we see with a lot of our investors is they'll come to us and they'll say, hey, look, I'm a tech worker and I've got really good income and I've got a 401k and I've got equity in my company, but I have zero real estate. And, you might have the same thing from a lawyer who says, like, look, I've got an incredibly high income and I'm trying to get partner in the company and maybe get some equity in that way. But fundamentally, I've got a 401k. And, the commonalities we see with a lot of our investors, doctors as well, is they're all invested heavily in paper assets like stocks and bonds and mutual funds. And if you look at the portfolio of the 1% or even the 5%, it's very different. They have a huge chunk of their wealth in not their primary residence, but true real estate investments, along with business equity and all sorts of other things. So there's so many people in America who have horribly balanced portfolios. And real estate is only one aspect or one asset that you want to have in your portfolio, but it is an incredibly important asset to have, again, that all of the 1% and top 5% traditionally have in there. So this is a great way to balance your portfolio and get exposure to real estate.
And that's to that point, we at RSN want to be that when you want to start delving into having a more balanced portfolio, that we can provide that chunk of your balanced portfolio, whatever that might be, 10, 20, 30% of your portfolio might be devoted to real estate. Well, then if you're interested, come and chat with us. So with that being said, Ben, I don't think there's too much more we want to necessarily cover here, but we can quickly go and just summarize the show for folks, and maybe you can tell people where they can reach out to us if they want to find more.
Sure. Sounds good.
So just to recap on what we've talked about, we've come everything from high level, why multifamily, why we're investing, providing shelter because it's a human need, and who are our tenants, working class folks. We spoke about where in the country we're buying, landlord friendly states. Affordability is really got to be really important in these areas that we're buying in. We then spoke about the asset itself and how we look to value the assets against other assets. We talked about the income. Where's the in-place rent today versus where we can take it to, and then we spoke about how we do go and do that and go and execute, because it's really important about the execution of that business plan. And we've done this over 24 different deals over the past 10 years. Then we spoke a little bit about the passive investing nature of investing in real estate, and the syndication, which is the coming together of real estate investors and operators like ourselves to form that partnership. And then we dove a little bit more deep into the benefits of real estate and talking about the difference is between paper investments versus hard assets, and why you want to have a balanced portfolio. Ben, did I leave anything out there in that quick little summary?
We covered a lot, but I think that's a pretty good summary. I'll just sort of like close and say, I hope this isn't too a salesy for our viewers out there or our listeners out there. That's not the intention. So if you have questions about, any aspect of this, let us know, because we want to do episodes that cover valuable content and educational materials that you want to hear. So let us know if there's anything that you want us to dive deeper on, and that will subsequently be the next episode that we do.
Yep. And so with that, Ben, where can people reach us if they want to find out more?
RSNPropertyGroup.com. You can fill out the form on the website. That'll put you on our mailing list. You'll then get alerted at any time we have a new deal. You can then reach out to us and communicate with us if you have questions or you want to jump on a call. But RSNPropertyGroup.com is your entry point to having any conversations with us.
Awesome stuff, mate. Well, look, again, thanks for jumping on the show. Thank you, listeners, for listening to the show each and every week. We try to provide as much valuable content because we're all about increasing your financial IQ. That's what we're about in the show. If you do like the show, you can give the show a 5-star review on iTunes. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.